This is Jody Trana with Unit 3, Potential Cash Sources of the course Cash is King. In Unit 1, we discuss the basics of cash flow, establishing an understanding of cash management. And in Unit 2, we discuss the ways that people report cash and evaluate it. In this unit, we're going to talk about the potential cash sources that might be available to fund the two main issues that people are most concerned with in cash flow. The first is working capital, which is just overall cash flow and having cash available for operations. And the second is for specific cash needs to purchase equipment or for growth issues or maybe for seasonal merchandise orders. So whether the business you're in will be seeking cash sources immediately or whether you are planning for future growth, this unit is going to be beneficial. You don't have to be looking for money right now. You need to know where money will be available in the future. This unit discusses that. The sources of cash will either be internal, external, or come from creative sources. We've already discussed one of the realities of funding and cash flow, and that is that commonly the owner is the one who generates most of the funds needed. Even when the external sources are sought, it's the owner's reputation and maybe even collateral that's critical to recruiting the funds. When the owner stops putting cash into the business, then it is the business itself that needs to pick up the responsibility of feeding internal cash back into the business. Internal cash is the number one source of cash for healthy businesses. When the owner and the business aren't able to meet all of the cash needs of the business, then the business either goes to look at external sources or creative sources of funding. We'll take a deeper look at each one of these. So we've already talked about the first reality of funding, that the owner is the one who generates most of the cash for the business, and then the cash comes from the business after that to fund operations. There's two more realities of funding. The first is funders' goals. This reality states that those who provide funding for businesses have their own reasons for doing so. They have their own concerns about each of the things listed here: timing, amount, control, the use of the funds, and the return on investment. And they definitely know how they want their funds repaid and at what price. Another reality, funders' interests. This reality states that different money sources are often interested in different stages of business and even different types of business. It's a personal matter. It's based on what the funder's interests are. All of these issues relate to the funders and what they're looking for. So the lesson here is that if a business wants funding, it has to find the funder who has an interest. Not everyone will. If you've ever watched Shark Tank on ABC, it's really interesting to note which one of the sharks is going to be interested in the different pitches. They aren't all interested in all of the pitches. They have different investing goals and different interests. It's the same with all investors. Debt financing. Debt refers to money that's provided by a lender with the understanding that the money will be repaid, along with fees such as interest or loan origination fees. Usually debts are collateralized, meaning that the owners pledge certain assets, often personal assets, to offset any loss to the bank if the loan is not repaid. We usually consider debt financing to come from banks, but other organizations provide debt financing too. Anyone who lends money to the business is providing debt financing. There's different views about debt financing. Many people view debt as bad today. Some view it as good. Most view it as necessary. The truth is, debt financing is neither good nor bad. It just depends upon the business's needs. Consider that there are good and bad ways to use debt financing, though. Let's think about this as a consumer for a minute. Most people view home loans and school loans as a reasonable way to use debt. Debt's expensive, but both of these reasons for borrowing should have a positive impact on future income. The school loans should lead to better paying jobs, and the home loan should be supporting a real estate investment. A bad way to use debt are for things that immediately have no value or decline in value, like going out to eat or buying clothes or going on a vacation. These same rules apply to business. Another issue about debt that frustrates people is that it seems that the only time you can get financing is when you don't need it. Banks only lend money to people who they think will pay it back. Although this is frustrating for the people who need the money, let's take a look at this policy from the depositor's point of view. When you put money into the bank, you want that money to be safe, don't you? You don't want the money lent to a risky business and potentially lost. The government has regulations that prevent the banks from lending money to risky businesses because it puts your money at risk. Not all businesses need or want debt to operate, but when debt is necessary, it's important to have good borrowing strategies. These will be discussed in Unit 4. In 1989, Bert and John Jacobs designed their first t-shirt, but the two artist brothers struggled to keep the t-shirt business alive. After 5 years of selling t-shirts, they took a leap and changed the message on their shirts to an optimistic "Life is good" with a simple stick figure artwork named Jake. Today, Life is Good is a $1 million company marketing t-shirts, hats, and other items through more than 4,500 retailers. Bert and John Jacobs bootstrapped for the first 10 years in business. When they hit $1 million in sales, they were approached by investors. But the Jacobs brothers wanted to maintain control of the business, and so they decided to seek bank financing instead. They wrote a business plan and got $500,000 in credit. Equity financing. Equity financing refers to those who provide funds to the business in exchange for an ownership interest. There's no standard equity agreement. Every situation is different. Usually the equity investor knows exactly what they want out of the business. The angel investor is willing to take on the risk of startups, and they usually use their own money, where venture capitalists often use other people's money for investment. The angel investor, they get involved because they have a personal interest, and they're often interested in the entrepreneur, him or herself. The venture capitalists, they don't usually provide startup funds. They like to know that the business is viable and poised for growth. Some of that is changing, though. And there's also other ways of financing through equity. Those are the IPOs and the private placements. IPOs are a way to raise money through the sale of stock publicly, and private placements are just that, private sales to a certain group of people. I have to admit, I watch ABC's Shark Tank once in a while. I think it's really done a lot to shed some light on equity investors. First of all, no two deals are ever alike, and no two investors are ever looking for the exact same thing. In Season 5, Episode 16, Bruno Francois from Cycloramic, which is a 360 photo app developer, they received offers from all 5 of the sharks. Each shark comes at the deal with different expertise, unique marketing strategies, and different financing options. Here's how it laid out. Lori and Steve offered $250,000 for 10% equity. Kevin O'Leary offered $90,000 for 15% royalty and no equity. Damon John offered $300,000 for 10% equity. And Mark Cuban, he offered $1 million for 30% equity. Now the Sharks made it fun and interesting by jostling for position, and they switched their deals around and changed things. It ended up that Lori and Mark joined together with an offer of $500,000 for 15% equity in Cycloramic. But what's really interesting about this story is that Bruno didn't really need or want the money. What he came to Shark Tank for was the expertise. It kind of reminds me of the rule of banking we just talked about, where the only people who receive money are those who don't really need it. Well, that really isn't the case with equity financing, but there is a lesson there. It's a lot easier for businesses to get the money and the things that they need and want when money isn't a desperate situation. One way a business can really shine and create cash flow is through creative forms of financing. All of these are discussed in the readings, but I wanted to just highlight a couple here. First, I want to talk about bootstrapping. Bootstrapping is just doing more with less, or doing without entirely. It's a very effective way for doing business and to establish healthy cash flow and to maintain control of the business. Here's a couple of stories of bootstrapping. Microsoft is probably the most famous. Bill Gates had his customer IBM pay for the product development. Another example is Leslie Wexner of The Limited. She launched her clothing store by bootstrapping a single location in Columbus, Ohio. And Estee Lauder, she created cosmetics at her kitchen counter. Bootstrapping isn't a new concept, but it is getting some new publicity. As old as bootstrapping is, the new standard may very well be crowdfunding. Crowdfunding raises small amounts of money from individuals in large groups by offering the people some kind of a reward, such as the opportunity to be the first one to buy a certain product when it's available. Crowdfunding for equity ownership is popular for businesses. Crowdfunding campaigns recently have been very successful. There are websites that host the crowdfunding campaigns, and they have raised over $5 billion in 2013 for individual crowdfunding campaigns. The most famous probably is the Pebble e-paper smartwatch, which they campaigned for crowdfunding for 37 days and they raised over $10 million. They offered the reward to be able to purchase the new smartwatch. That's it. Grants are another creative financing method, but they really are not easy to get. Grants can be extremely useful if you have the exact thing that a grant funder is looking for. Some examples are the National Science Foundation. They've been favoring energy projects lately. They're awarding grants probably on the smaller end, about $25,000, for companies to conduct research in areas that are particularly useful for them. There are other grants available, some larger grants available from foundations for maybe more specific projects, things that they're looking for, the Ford Foundation, Rockefeller, Kellogg Foundation. These grant processes are all fairly lengthy and complicated, and you usually have to apply at this specific time every year. Grants are also possibly available from some government agencies, but a lot of time should not be spent in applying for grants unless you specifically can provide what that funder is looking for. We will be talking about borrowing strategies in Unit 4, but I just wanted to discuss here approaching potential funders. When you approach a potential funder, you need to remember the realities of funding. The first reality is that the owner and the business generally supply all the money needed to start and operate the business. I know I keep repeating that, but it's important to understand because that's what the funders are looking for. The investors and the lenders are both looking for the owner and the business to have contributed substantially to the business. The funders are also looking for specific goals of their funding. That's the second reality. And the third reality is that funders have special interests when funding. So if you keep those realities in mind, it'll help you as you approach potential funders. First of all, let's look at the lender's requirements. Here are 5 qualities called the 5 C's of credit: character, credit capacity, collateral, capital contribution, and conditions. These are the 5 qualities that lenders look at most often to evaluate a loan application. These are discussed in greater detail in the readings. Let's also look at investors' requirements: return on investment, personal interest, sufficient information, and level of involvement. Basically, the investors want to know how much they stand to make on the deal, but they also need to have a personal interest. Here's my last word on funding. Decision makers sometimes get so eager to get funding that they sacrifice some of the business goals in the process. Keep in mind that the process of funding is not just about getting money. It's a long-term decision that affects how business will be conducted in the future. Evaluate the potential funders at the same time that they are evaluating the business.